Thank you so much, Siddharth sir, for taking out time. You obviously need no introduction. The entire crowd who's attending this session is extremely excited for this Q&A discussion with you. We have received a lot of queries from our candidates. What we have done is I'll be the moderator on their behalf. I will be coordinating on those queries with you. And these queries are mainly from their learning at our academy. And on top of it, what they have read from Ambit, the research materials and everything. So that it's a combination across the bay, and we've tried to segregate those through multiple line items in this Excel file. Hopefully it's visible to you. And
yes.
I'll read out the questions to make it a bit of more interactive rather than just reading the questions there. So with your permission, shall we get started?
Absolutely. In fact, what I suggest, Shailesh, is you remove the slide and maybe you can just read the questions and I'll answer those questions. That'll be better so that we can have an open interaction rather than having a planned interaction, I would say.
No, it's obviously not a planned interaction. The reason I wanted to share the list of questions is in case we plan to share this recording over our YouTube channel, so for viewers to be able to understand which question is being addressed.
Do what helps you most. Go ahead.
Thank you so much, sir. Thank you so much for that. Sir, to get started with the first question, we wanted to basically understand how do you check whether the revenue is growing sustainably for any particular company? Because you see a lot of growth in revenues at times, and sometimes you're not able to distinguish whether it's a structural growth or a cyclical one. How do you go about, segregating around that? Because when, let's say, if a business is growing for 2-3 quarters, suddenly people talk a lot about it. Suddenly people start talking about that particular industry a lot, and everywhere in journals or investor memos or letters, everyone is talking about that particular industry. How do you go about distinguishing that it's just a cycle which is going to pass through, or it's actually a structural change which is happening in that industry or that company?
So very, very interesting and pertinent question. So hence, in our coffee can portfolio, we look at, I'll tell you what Ambit does,
right,
and
sir,
what we intrinsically look at. So there are two aspects to it. So first is a very generic way, which I can tell you that what Ambit looks for in our coffee can portfolio is 10 years of consistent revenue growth, Y on Y, not Q on Q, Y on Y greater than 10%. The only exception to this can be a macroeconomic event, something like COVID. Even a war or a catastrophe or a natural calamity is not an exception, because that will last little for a shorter period of time, and it will be only happen for a little while. However, COVID lasted for nearly 1.5 years, if I have to say. Hence, that is the only exception here. Otherwise, what you will do is you will check for 10 years, Y on Y revenue, minimum of 10% growth. Why this 10% number? There is always a reason to this madness. There's always a logic to every conclusion which we make, and that conclusion or that reason is inflation by and large in India. Is closer to 7 to 8% or 6 to 8%. The sweet spot for inflation is around 4.5 to 5.5%, but it has been in the range of 5.5 to 6.5%. Even if I take the upper end of the inflation, which is around 6 to 6.5%, it essentially means that technically revenues are not growing, because your inflation, without having any real growth, itself is taking the revenue up by 6.5%.
Right.
Hence, bare minimum, the volume growth should be between 3 to 4%. And that's the reason this 10% magical number.
Got it.
So that's number one, which we look at from a very, very basic, and this is an algorithmic thing. So, you don't have to worry too much about reading the books, because these are the numbers which you just put it into the algorithm and you get things out. Another interesting thing from a since you are a teacher, intrinsically you are a shikshak, and to understand the basic of it. How, so this is something which I said from a fund management perspective, but that's not the thing which students should look for. What you should look for is, if there is Q on Q, quarter on quarter revenue growth, first, do not look at quarter on quarter growth. So that's number one. Number two, look for at least, even in a small and a mid cap company, look for a 5 years or a 6 years revenue growth between 8% to 12%. Why this number? Why 6 years and why 8%? The reason 6 years, because generally economic cycles revolve around 3 to 3.5 years. Hence, you are able to go through two revenue cycles or two economic cycles of revenues up and down. And if you see consistency, even then, it means that the companies are doing fairly well. 8 to 12, because these are mid and small cap companies, hence there can be variability, pricing power, challenges from the input cost, etc. Hence, or the demand fluctuation, and hence you are giving a little bit leeway from 8% to 12% instead of fixing with a 10% number, which I mentioned in the initial conversation. So that's number two part. Number three, always look at, if there is sales, there has to be a contra entry. We all understand basic accounts. That has to convert into cash flow from operations. So if you are saying that sales is jumping for 3 quarters, the first litmus test or acid test for this is, what is the cash conversion ratio? Cash conversion ratio essentially means how much of this sales for 2 quarters or 3 quarters, which people are buoyant about, is actually translating into money into the bank account. Frequently we see sales happens, but corresponding cash basically means the bank balance is not rising. Doesn't make sense. What is happening is large part of the sales is getting converted into receivables, because that's the only contra entry. If it is converted into receivables, then quickly check if 2 quarters, their receivable days have increased or not. If receivable days are increasing, sales is increasing, cash is not increasing, or cash flow from operations is not increasing, whichever word you want to use, these are all interchangeable. It essentially means there is a possibility of bogus sales. And hence, hold your horses then.
Got it, sir. So just one follow-up question on this, like when you said 10 years data we take a look at, but sometimes, you know, some industries may not be that old as well, correct? So they may have emerged recently.
100%. So companies may not be that old. The industries are generally that old. Even companies are that old, they may not be listed.
So what if the industry is relatively very new? I mean, it doesn't really have that many players. You know, some industries are known to be very small. Maybe they have 2-3 players in the listed space, as well as, you know, it's a very niche industry. How do you go about taking a look at such industries, or do you, you know, ignore those from an analysis standpoint perspective?
So if you're asking from the fund management perspective, so again, there are 2 aspects. One is from a personal investment perspective and from the fund management aspect. From the fund management aspect, we will be quite stringent about the fact that we will look at only cyclical companies. Hence, they would have history of 10 years and they would essentially have track record of more than 10-15 years. So and that's largely on the large cap side. Hence from the fund management, but what you should do, so your point is relevant. What if the industry is nascent and there are only 2 to 3 players? It's a very, very valid question. So what should one do? What should one do is very simple. Then apply the second method, which I said. Look for at least 2 cycles. So any industry should at least go through a cycle for you to know whether that is gonna make money for you in times to come. If you are only calculating basis one cycle, doesn't make sense. So at least 2 cycles which will complete in 5 to 6 years, number one. Number two, see the cash conversion ratio, cash flow from operations as a percentage of sales or cash. So how much is the sales getting converted? Right. So cash conversion ratio, basically the amount of money which you are receiving in the bank against the sales. So that's number two. And if the cash flow from operations or the cash or the sales cash sales is dipping, in that sense, then check for the receivables and receivable days. You'll get your answer. And if you're still only chasing sales, then don't do it, because in 3 or 4 quarters, you'll see a major setback. Generally, what you're saying, Shailesh, happens. A lot of companies do this just before the IPO. Unfortunate, but they do it. Right. So.
Got it. Makes sense. Thanks so much for that detailed answer. So the second question is more on the lines of actually understanding the strength of a industry. Like we've all read Michael Porter, we understand the framework, the mode framework, but exactly which factors, according to you, from an organization standpoint, are really important and the factors which you obviously take a look at in determining the strength of a particular industry's, factors like maybe entry barriers or industry rivalry. How do you go about analyzing those?
Okay. So the first thing from the industry perspective, what we look at first thing is, what is the kind of, so we always, actually for us, it's always a bottom-up approach, but nonetheless, we always have to look at the industry as well. So from the industry perspective, we generally would prefer an industry where external interference means anything which is dependent outside the industry or the industry participants should be very, very limited or restrained. I'll give you a very simple example. Sugar is a phenomenal industry. It's an evergreen industry because people cannot not consume sugar, right? It's a fantastic industry. The problem with sugar is it's a regulated industry, highly regulated industry. And the government has to look for the social welfare always while putting a price or rationing on the sugar. Now, you would say that it's such a industry which it can never die. As in foreseeable future, maybe for next 20, 30 years, people consuming sugar cannot not happen. Hence, there is perpetual demand, and the demand is only increasing because as the population is increasing, consumption is increasing, and it is much more vigorous than even cigarettes or alcohol. But then why should one look at, and why, and then this begs the question, why sugar stocks for a longer period of time, I'm saying not for a shorter period of time, for a longer period of time, haven't done so well? Exactly the reason. The first thing which you should do is, does government or any external power has control on reducing or managing the margins, whether gross margins or the net margins of the industry? So that's the number one aspect, very, very important. Number two, beyond the government, there can be international reasons which are beyond your control. Reasons can be multiple, but if you have pricing power, are you able to pass on that increase in the price, which is from the external side? I'll give you an example. It will make things very, very simple. If a steel company decides to increase the price obnoxiously because their cost of production is going up, can they do it? The answer is no. And they can be very, very large company, because steel prices globally are determined globally. Hence, the pricing power of the steel is not It's a very essential industry, but still, it's not something which is in your hands. On the other side, paints, for example, 70% is determined by the crude. So the crude forms large part of the cost for the paints as an industry. However, the brand or the reach which the paints company, at least in India, they have done, or even globally as a matter of fact, the resilient paint companies, they are able to pass on the price high without having any impact on the demand. So what these paints companies have done, they have created a kind of an inelastic demand scenario. So second thing which we will look for industry per se is how much control you have on the demand if there is price hike. So that's number two. Number three, we will look at, obviously, which is very, very basic. What is the runway for the industry? Runway for the industry means whether this industry is bound to grow at least high single digits or double digits, early double digits for next at least a decade. At least a decade. It should be more, it should be 2 or 3 or 4 decades, but at least it should be a decade, because at least I have runway. Otherwise, what will happen? The companies will start perishing very, very quickly. These are the basic first level checks. Then comes the moat, the defensibility, etc., which everybody understands. I don't want to talk about it, that how you can ring fence the margins, etc. But these are the basic things. First, interference. Second, your control on the demand. How much can you have in elastic demand? And third, the longevity of the existence or the relevance of that industry.
A follow-up question on that. How do you go about determining the runway? Like how do you go about figuring out a 10-year path about a particular industry, which I understand from Ambit standpoint, obviously you don't look at nascent industries, let's say, but if you have a 10-year history as well, but then how do you go about determining the forthcoming runway about that industry?
So very, very simple. You have to start look at the current disruptions which are happening in and around.
Right.
And imagine what will happen in future in times to come. For example, I'll give you a very simple example of it. In 96, the weight of PSU banks in Nifty was approximately 26 odd percent. Today, 25, 26 years later, it is closer to 2 to 3% odd. And private sector, which was around that percent, has become 26%. If you would have seen in 91, there was democratization of capital, which happened, which means a lot of capital got freed up, and there were a lot of financial institutions which started borrowing and lending activity in competition with the PSU banks. The result of which, obviously, the competition became intense. And that's when we saw some bit of loss in the market capitalization. Now, as soon as these reforms happened, one thing was very clear, that there will be newcomers who will start pushing the expansion of market share, and the old guys somewhat down the hill if you are not agile. So this is the job which you have to start doing, of foreseeing what lies ahead. For example, after demonetization, not even COVID, after demonetization, one thing was very, very clear, that fintech or technology in finance or technology in money is going to be the future. Now, Today, you have lenders who are still being brick and mortar only. 5 years, 7 years down the line, lenders which are not pivoting towards technology as an enabler, technology as a medium to disburse, they will find very challenging times to even exist. Hence, you have to see every event is doing what. And another example I'll tell you. When COVID struck, we saw, so there are two things which never stop generally in any country, including India, which is marriages and children being produced or children having birth in any country. And that's what happened in India as well. But when COVID struck, it was very interesting. Before COVID, if you have to buy a piece of jewelry which is worth 1 lakh to 2 lakhs or 3 lakhs, and especially for marriage, what will you do? You'll at least visit the jeweler, the local jeweler, the whosoever whom you trusted, because this is, remember, tons of money and gold and an auspicious occasion of marriage. Hence, you will at least make 4 or 5 visits. COVID didn't allow you that. Maximum 1 visit. So what happened? The industry changed to trust. People who could be, or the participants on the industry who could be trusted with a single visit, grab the market share. Will it reverse? The answer is no, never. COVID is gone, but will it reverse? The answer is no. So that's the trend which you have to see with every macroeconomic event, how the industry which you think is resilient is now broken down into pieces. There will be a couple of participants in the same industry who will pivot, who will do backward integration. When auto margins were thin, because the dealers used to take large part of the margins, couple of auto companies, what they did, they started doing backward integration. They started manufacturing the ancillaries themselves, the tire themselves. So remember, that shows it's more to do with the company than the industry, because industry will always have not a straightforward path, a zigzag path. The guys who adapt to it will lead.
I totally could relate to it. I think something similar is happening in the paint space with Grasim coming up with a crazy amount of capacity plant. With Asian Paints with more than 10 years of history has almost twice that of size. The industry will tell what's going to happen next. Anyways, thanks so much for that detailed answer. Moving to the next question. Investing is basically about detecting patterns, right? So obviously with your history, with Ambit Capital's history over a period of time, we wanted to understand, like, the positives factors we understand, but what kind of risk factors do you take a look at, or a pattern which you may have seen over the years, which typically results into a permanent destruction of wealth for the investors? Like, I'm pretty sure you must have some sort of a the risk framework and everything, which obviously from an Ambit perspective.
Correct. So absolutely. So risks. So I always believe in equity investing, it's never about growth. It's never about success. It's never about returns. It's first, it's about protection, preservation, and de-risking the investment where you are going to make. That's the first aspect. Because if you can't protect, things can be very, very tough. Hence, what the question which you have put is brilliant. So the first thing which we look at is we generally try and pick up, barring BFSI, we pick up businesses which are generally debt-free in nature. Generally. So it needs to be It can be 0.1, 0.2 at best debt to equity. Otherwise, we would prefer businesses which are generally debt free. So that's number one. Number two, the debt should not be incremental, and working capital debt is essentially not a good thing to have. Working capital debt means you are absolutely hand to mouth, which means you have no pricing power, no margin enhancement capability. You're running pillar to post. The debt can only be there for the capex, and capex is only because you believe the incremental demand which is coming is gonna give you incremental margins over and above your existing margins. Not the same margins, it has to be a little higher, because that's when I will get my alpha. If the margins are expanding, then the cash flows after a point in time will start coming and you will start repaying the debt, right? So debt has to be gradually reducing, if 4 quarters, 8 quarters at best. You can't have a scenario and debt is after 8 quarters also. And investing is generally a patient thing, so 8 quarters is not a very long period of time, right? So 8 quarters, despite of that, the debt is increasing. So that's a very, very big red flag. Second thing, in the large cap, we understand, because and especially in the strategically important industries for the nation, the shareholding cannot be very, very large. So we have regulations in banking, we have regulations in financial industries, financial sector, etc., etc. However, in the mid and small cap, we would actually be worried if the promoter is constantly exiting. We'll be quite worried about it. And we would love a business where the promoter has anything from 40% to 60%, or higher the better, but at least 40 to 60% skin in the game. Because then, if I am a promoter, then I would not get my son at a 5 crore salary. I would get the son at 50 lakh salary, even if I have to induct him in the business, because 4.5 crores of savings which I'm doing will give me a P multiple multiplied an extraordinary, even if the P multiple is 20 times, 4.5, 90 crores. So imagine I'm paying a salary of 4.5 crores to my son, 4.5 crores he'll pay 35%, 42% tax actually. So he ends up getting roughly around 2.8, 2.9 crores kind of thing in hand. Okay. As against that, if I'm a smart promoter, I'm saving 4.5 crores because I'm only paying 50 lakhs as a salary. 4.5 crores multiplied by 20p multiple, because ultimately it's impacting the bottom line. I'm paying tax of 25% as the corporate tax on 4.5 crores, which means 1/4 gone, which means roughly around 3 crores, 70 lakhs, 80 lakhs odd, or 3 crores, 30 lakhs odd. Multiply that by 20, which is roughly around 60, 70 odd crores. Out of that, 40% is mine or 50% is mine. So 35 crores of incremental market cap for me. Which one makes sense? So a smart guy looks at all that, and that's what we are interested in as well. Because if his skin is in the game, we are very, very comfortable. Another thing we see, the autonomy of the management. What does that mean? How independent is the board? Are the independent board members truly independent, or they are the relatives of the promoter only? You understand what I'm saying, right? If the board is truly independent, they'll only be interested in protecting their reputation, number one, ensuring that the company grows, ensuring that whatever happens in the most ethical manner. Because remember, if the company grows and they are on the board as independent, their net worth also and their credibility also increases, because generally independent board members also get a little bit of equity. So it's everybody's interest which is aligned there. So that's another thing which we look for. Another thing which we are very fussed about is how the company is treating their ecosystem. What does it mean? It very simply means these companies are bigger. These companies are large companies. Whether it is a large cap or a small cap, they are relatively large. But their suppliers, distributors, wholesalers, retailers, they are relatively small business people. How these business people are being supported by the company during tougher times tells us what is the runway for the company for future. Another very simple thing if you want to check is the attrition. So barring IT at a lower level, attrition is a very good way of understanding what is the future of the company. If you see some quick rolling of heads or quick movement of senior people exiting the company, it's a red flag. Remember, their salaries are there in the balance sheet. So if you look at the annual accounts, top people who are being paid generally 50 lakhs and above, their salaries are there in the balance sheet. It essentially means that these guys are paid handsomely. Despite of being paid handsomely, what is it that triggered their exit? One can be my personal aspiration, but not for everyone, which means something is not right. And that's a big red flag. So these are also, we are quite worried when there is a management change happens, when there is an M&A, and if our company is being acquired, or there is a huge or the management change from an independent management, there's a management which is one-man show, we are quite worried about it. Because we believe that processes
are better.
give you success. It is one of the very key aspects whenever you are industry research or the company research. One thing we categorically look at is the process and the replaceability of people. Because we, in our mind, it's very simple formula. Good people have capital. They use capital to hire good talent. Good talent creates good processes. Good processes create good scale. Good scale creates growth. Growth creates market capitalization. Very simple. Wherever there is a process problem, trust me, it's a matter of time. It can be 2 quarters, it can be 20 quarters. Things are going to collapse.
Sir, I have a lot of follow-up questions. Please bear with me. And by the way, they do relate to the question subsequent present in the file. So the one question which you mentioned was you don't look at companies which have debt or probably accumulating debt. Now, there are quite a lot of industries which cannot survive without debt because that's precisely the structure of the industry. Then you probably never gonna play that industry or company in those particular industries. Is that so?
So we are not. So there are 2 aspects. We generally avoid playing such kind of industries from the portfolio perspective, but from an academic perspective, you can't ignore those companies or those industries. Now, what do you do there? Very simple. What I said, even if you are taking debt, the debt should not be accumulating on account of working capital, number 1. It cannot be burgeoning because of working capital. So that's number 1. Number 2, capacity creation does not happen every quarter or every year. Capacity creation generally happens with a time lag of at least 1 cycle or 2 cycles, which means with a time lag of 3 years, 6 years, 12 years, 10 years, something like that. It essentially means then you have to see the trend of the debt. If you have taken the debt, fine, no problem. After 6 quarters, the debt has increased. Doesn't make sense. After 6 or 8 quarters, it should have at least become half, if not anything else. That's the point which you have to look for. Because people believe someday the debt will come. Someday the order will fructify into cash flows. Order has come, debt has increased, cash flows are minuscule, and then one fine day you see your favorite company in NCALT. We don't want.
Got it. But sir, at the same time, they're just probably waiting for their day in the sun. And that one fine cycle is gonna correct everything for such companies. If you are a prospective investor, just waiting for the tides to turn around, or do you actually exit such quotes?
Are you investing on hope, or you are investing on merit and the prowess of the company? If that would have been the case, so let me give you a simple example. There are a couple of infrastructure companies, and I'm not going to take the names of the companies. They are in the top bracket. They have debt, but their debt has been gradually reducing every time. The cycle thing which I explained to you, the cyclical thing which I explained to you. Similarly, so there are two industries. One is commodities, one is infrastructure. So these are two, as you mentioned, debt heavy industries, right? Both, you have some players, I would not say many players, but some players which follow this pattern of taking debt and then gradually reducing their debt. Whilst lots of them follow the policy which you said, that someday my cycle will turn around. I'm all right if I want to look at some businesses, although in principle we don't invest as I mentioned, into cyclical sectors, but from the academic perspective, what you should do is look at the absolutely quarter-on-quarter reduction in debt. It's as simple as that.
Got it. But sir, let's imagine a scenario where, so when you say reduction in debt, are you talking about debt proportion in overall capital of the firm, or absolute reduction in debt are we referring to?
So both. I would mention both. So debt to equity should improve. Mm-hmm. Now debt to equity will only improve under two scenarios. So another interesting thing. So if you have large amount of debt, you will have interest outflow. If you have interest outflow, which means your profitability is going to come down. If your profitability is going to come down, your debt to equity, because ultimately profit is going to be added to your net worth, so your debt to equity is anyways going to get adverse. So that's number one. The only way to solve it is after a point in time, when you have done the capex, when your cash flows are coming, you start paying off the debt.
Right.
That's the only way in absolute terms or in debt to equity, both, you will see improvement.
What if the firm goes for expansion mode by raising funds through other modes of equity, or let's say less proportionate debt, which obviously results into reduction of proportionate debt into the overall capital structure, thereby posing less risk, right, from a levered perspective?
100%. That is the reason companies do a QIP. That's the reason companies do IPO. And here we are talking in general, right? So it doesn't matter whether you are a listed company or an unlisted company. Absolutely. That's the reason companies should do QIP. That's the reason companies should do a IPO, or companies should do if you want to do even a strategic exit, not to the listed, but you want to bring a technology partner where you want to give some equity, where he can bring in technology plus some equity, where that money can be used with the technology for expansion. So all permutation combinations are available. And if the company is credible, I am not at all worried that even if the stock price corrects, because there will be more equity paper which will be available in the market, and the equity price is correct for the interim, it's fine. Don't worry about it. That's a good signal.
Got it, sir. Got it. On the second point, you mentioned that the promoter stake should be increasing. Now, what if the promoter were to
increasing or at least constant?
Sorry, yeah, increasing or either way constant from your
Yeah.
firm's investment philosophy standpoint, correct? What if the promoter is actually pledging his own shares to get more funds to increase stake in the firm, which by the way has not turned out well for all the scenarios. Let's talk about Yes Bank or even Z. So, in such scenarios, how do you go about taking a look at that point?
Okay. First is, why would you pledge your own shares? Because see, remember, stock price, there are roughly around 100 million people, 10 crore people, 100 million people who directly, indirectly, FIs, DIIs, institutions, etc., 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 participate in Indian equity markets or more. How can you determine how the price movement will happen basis the perception of these 100 million people or more? As a promoter, your job is to run, promoter or management, your job is to run the business efficiently, ensuring maximization of the cash EPS. That's about it. That's the fundamental goal in the best ethical manner, right? Now, if you believe that the company is undervalued because I'm going to do expansion and because of that the valuation will increase, etc., etc., and hence I will start pledging my own shares and taking money from the market and then buying my own shares, it's not something which is very
sorry, sir. I was probably not clear in my question. What I wanted to understand is, from your perspective, the way you look at promoter stake in either stable or increasing, you're basically looking at the way whether he's more into the game in comparison to other promoters, correct? So if a promoter is actually pledging his stake and buying more shares from the markets by pledging his own shares to increase his stake, doesn't that indicate he's more into the game than any other promoter out there?
Shailesh, it's not the case, because generally what is the guarantee that after exactly what you're thinking, everybody will start thinking and the prices will move up and then I will dump my shares.
Right. So you guys are basically against pledging. That's precisely what I wanted to.
Yes.
I wanted to get that color. So when you take a look at promoter stake, either increasing or stable, you obviously do take a look at pledging as well then.
100%. We would not take pledging as a very good signal, as a good sign.
Right. Exactly. I wanted to get color on that. Thank you so much, sir, for that clarification. So moving to the next question, in terms of management quality, you mentioned that you take a look at the independence of the board and whatnot. What if we wanted to judge, how we wanted to judge the capital allocation track record of the management? How do you go about taking a look at that?
Very, very simple. Just look at two parameters. One is ROC, return on capital employed.
Right.
So if your return on capital employed is north of 14-15%, it means that you have done reasonably good job with the capital which you have. So that's number one. Number two, what is your line of business? If you are in auto, are you spreading your wings in road construction as well? It's a absolute no. If you are in the construction business, are you getting into water business? So very simply, as a philosophy, we would tend to avoid conglomerates as well.
That was just my follow-up question.
And the reason is very, very simple. When my left hand pains, my right hand comes and eases it out always.
Right.
So doesn't make sense.
Makes sense. Thanks so much for that. The next question was on a forensic accounting, but I think you talked about a lot of other indicators from a forensic accounting standpoint. Obviously, keeping Ambit's philosophy in mind, which factors, like top 3 factors, you you'd want any particular analyst to take a look at? I think you've already mentioned one is cash conversion, whether business is able to convert that.
Correct. So cash flow from operations divided by EBITDA. So that's number one, which I spoke about already. So, whether it is sales conversion, cash conversion, or sales by EBITDA, it's one and the same thing. So that's number one. Number two, we look at very, very simply is the depreciation, the change in the depreciation policy of the company. Very, very simple, right? There, you understand that a whole bunch of companies keep changing their depreciation, and why would you want to do that? Number three is the change in auditors. Change in auditors before the end of the mandated term by SEBI, especially in case of the listed companies. It's a big red flag, and especially if the hike is not linked with the inflation, it is 40-50%. That's again a very big red flag. Another big red flag is the receivable days. It's again a important component. We all understand between 91 to 121 days is a sweet spot for receivables. Anything breaching that, those receivables are never going to come. They are there in the books. During good times, they will be written off. Everybody knows that. But we still do it because we want to jump the profitability. So these are some of the ratios, done 11 ratios of such sort from the forensic accounting perspective.
So do you follow this quants-based mechanism to filter out ideas for yourself, from an organization perspective, or you probably, as you mentioned, you go from bottom to top approach, correct?
No, so what we'll do is absolutely. So we'll do the first one. So what our thought process would be, we would want to clean out all the hay, all the chaff from the grain, and we will then only process the grain. So these are eliminating factors for us. After elimination, then we will start our research.
Got it, sir. Got it. Makes sense. Sir, in terms of, we talked a lot about revenues, right? So I wanted to understand, in terms of margins, what do you think are the key drivers? Like you talked about pricing power of a business when we were discussing revenues, correct? So from a pricing power perspective, how do you go about taking a look at whether the margins are sustainable, right? So because the industry is obviously going through a pull on the demand front, or it could also be going through a supply chain issues, or as a matter of fact, let's say from a contraction perspective, there is an excessive capacity creation in the industry. How do you go about taking a look at that, where this equilibrium is going to come, and probably the margins will become sustainable in that particular range for a particular company? Or
so very simple. To look at anything, we can't predict the future, right? So look at the past. Right. And the good way of looking at the past is 2 cycles, as I mentioned. So the thrust is 10 years for the large cap, and for the mid and small cap, especially, we should look at at least 2 cycles, economic cycles. It will tell us how because it cannot happen that the capacity expansion or the excess capacity only like today. It's unusual, right? It would have happened. So it would have come sometime back as well. And how did the equilibrium came? So that's number one. Number two, from what we try and look from the margins perspective is, what are the newer players doing and who all are entering? And how is the industry demand? So you spoke about paints as a sector, right? So paints as a sector is growing around 12 to 14% CAGR for last decade and a half, which essentially means that the pie is increasing, and with every new entrant, the pie is only going to increase. As a paints as a category, per capita consumption of paints is 25% as compared to the West, right? So we have still a long way to go. You paint your house once in 3 years, once in 4 years. If there is a crack in the West, they immediately come and paint. They repair it and then they paint it, right? So that's their different thought process, which India also is going to imbibe. So the consumption is increasing. So even if there is excess capacity, new players, we would want to have a scenario where there is moat, where there is, like in cigarette business, very difficult to enter. But where you have excess capacity or new entrants coming in, is the market expanding? If the market is expanding, so very simple. People believe that Ayurvedic toothpaste, there was no market for it. There was absolutely no market for it. A large MNC company came, launched it, became unsuccessful. A domestic company came, make the entire Ayurvedic toothpaste a bonanza hit. There were 3-4 players in the Ayurvedic toothpaste back then, and Ayurvedic toothpaste as a percentage of the total toothpaste as a market 15 years back was less than 3%. Today, it is competing neck to neck. So the point I'm trying to make, new entrants sometimes expands the market multifold and the benefit goes to the older guy. So by the way, the largest player in the Ayurvedic toothpaste is the older guy who got failed. So every and India is a very unique marketplace, Shailesh. If you have reasonable acumen, if you have reasonable sense and understanding of the business, and you have reasonable integrity and ethics, any business in India breaks even at the operating level in 1095 days, 3 years. Any business in India breaks even at the PAT level in 1765 or 80 days, which is 5 years. Any business. That's the beauty of India. So the only challenge is between 0 or between 3 months to 18 months, that 15-month window, that's the toughest period for the business. If you are able to sail through these 15 months, you'll make it.
Got it, sir. Got it. Thank you so much for that, sir. It really makes sense. So the next one is basically more on the valuations front. How do you go about finding out whether a sector is actually peaked out in terms of valuations and probably gone through the trough and is at the bottom of the valuations? Like, how do you find out a right answer to that?
Okay, so see, remember that sector, you have literally no control on the sector, because sector will go through its cycles, and even the most resilient sectors will go through the cycles. Let me give you a very simple example of it. And you have actually no control on the sector P multiples. At a point in time, PSU banking as a sector at even 0.3, 0.4 was looking bad. Today, it is closer to 1 price to book. It's looking reasonably good for buying purposes, right? So, and if I say that I was right then and I'm not right here, doesn't make sense, because remember, you can't try and time the sector P's. You can't. Another example I'll give you. Just go 5 years back. Just go 5 years back, not very far. 2017, 2016. Mid-cap IT and small-cap IT, P multiples never used to cross mid-cap IT and ITES, IT-enabled services. It never crossed 12 to 13 times PE multiples. The sweet spot was between 8, 9 to 12, 13. That's about it. Large cap was between 16 to 18 times. Sometimes they will go to 22. Otherwise, that's the sweet spot, 16 to 18 PE multiples. Fast forward, COVID came. Small cap and mid cap IT went up to 30 plus, 32. Large cap came to 22, 23, 24 at the upper band. Now, if you think you will start comparing it, hey, look, 2017 I was getting the same business at 10 times forward or 9 times forward. Today I have to buy it at 25 times forward. Be my guest, you'll miss out the rally. So to be honest, There can be re-rating. Now, today, everybody talks about market cap to GDP. Historically, market cap to GDP, as soon as 100 crosses, expensive hustle and bustle starts. So everybody starts talking it's expensive. It has to be in 70, it has to be 80. The point is, look at the Western markets. India is the fastest growing economy. You never gave premium to it. Now people are realizing that India is going to grow faster. And if the P or if the market cap to GDP moves up to 120, 130, it's fine. It is going to happen. And it will be the normal. It will be the new normal. So don't try and be more intelligent than the market, you'll lose out.
Got it, sir. Thank you so much for that. So the next question, we wanted to understand, how do you go about, generating an investment idea at Ambit Capital?
So for us, it's very, very simple. We have a bunch of analysts. We have a whole team of analysts, not bunch. It's a large team of analysts, and they track sectors. So as I mentioned, we only look at cyclical sectors which have, and when we remove most of the cyclical sectors, we are barely left with 6-7 sectors. Then through these filters, we are left with these businesses, right, which are not very many in number. And then these analysts have to start doing research, and that's when they do deep dive research of of meeting the ecosystem, understanding from the ecosystem what's happening. And then there is a whole process which I explained to you in a nutshell, and that's how they then ideate and come up with the idea. So the first leg is removing the cyclicality. Second is the algorithm or the quant, which enables us to remove the chaff from the wheat, and then our analysts start processing the wheat. Yeah.
Got it, sir. Got it. So thanks so much for that. So there's this one question where you've written a wonderful statement that timing in the market is more important than timing the market. Now, when we actually thought about it, it did rhyme a lot. But then, let's say if you have spent sufficient time in the markets, how do you go about rotating across sectors? The portfolio rotation across sectors. How do you go about doing that?
So the first thing is, we generally don't believe in too much of sector rotation, because as I mentioned, we eliminate the cyclical. But from the academic perspective, from the investor's perspective, what you should try and do is, you cannot get ever any perfection which is any kind of perfection in the timing the market. So what you should do, let me give you a very simple example, because examples help in understanding better. So today you are seeing Nifty at the peak, right? Three sectors which are currently the bedrock, or also going to thrive in future, are hugely undervalued from the relative perspective of the past. Chemicals, ITES, pharmaceuticals. All three would be needed by India and by the world as well. You cannot live without these, fundamentally, very, very fundamentally, right? Now, if you start thinking that, hey, look, I should move my money entirely into discretionary consumer goods business, that's a great idea. Or I should put my entire money into PSU banks. So somebody who has invested PSU banks, as I mentioned, in 2012, is making tons of money now in a span of 10 years. After 10 years, PSU and PSU pack is doing extremely well. The good idea, if you want to do, take out money some from there, get into the sectors which are being beaten down for no fault of the earnings, a little bit of margin compression, but because of the external factors like war, because of the geopolitical scenario, get in there. And whatever you will buy, which is quality, which is the earlier conversation we had about the parameters of the quality, debt-free, etc., you will never go wrong. Give it 3 years, you'll be able to participate in the cycle.
Got it, sir. Thanks so much. Sir, on the same aspect, in fact, the next question. So when you say timing the market is not really as important as spending the time in the market. But
Absolutely.
then, you know, if we to look at the data, you know, 1% of the days give the best returns in the portfolios, and 1% of the days are worst for the portfolios. But then if you spend so much time in the markets, you're hoping for the 1% to be the top one, you may run the risk of having the 1% at the bottom one, right? So then at the same time, then people then think of exiting the portfolio, then you are essentially timing the market. It contradicts the same statement. How
Correct.
do you go about addressing that dilemma of spending time in the market, but at the same time not exiting the market when you think everything is boiling down to that 1% and you're probably having that worst possible day ever?
So very, very simple. You will always try to exit at the peak, and then you will always try and enter at the bottom, right? Whether it is a stock,
Theoretically, yes, but then you said it's literally impossible to pan it out, right?
100%. So if it is impossible, then how are you going to do it? Because if it is impossible, so the only, see, 1% of the days, if you miss out, the returns diminish significantly, right?
Right.
Another challenge is that most people look at Nifty as the benchmark to ensure when to enter, when to exit. There are a whole bunch. So when Nifty made its high, there were only, so India has roughly around 7,460 odd listed companies. Only 5% of the companies made their 52-week high. Rest of, and large number of companies were actually hitting their bottom 52-week low or around that number. Now, how would you justify that? There is no justification to it. The problem is that's the reason what you should focus on is, rather than the PE multiple. So you understand, it's very simple. Stock price is equal to PE multiplied by EPS. You can't control the PE because PE changes the price every minute, every second. Only control the EPS. Look at the EPS constantly. Constantly means, and that constant does not mean constant. Constant means you should look at once in a quarter.
Right.
And if you're able to do it, you know what is, at least what is your entry time. If not the exit time, you know what is the entry time.
Got it, sir. In fact, on the same note, I have one question noted down here where we were talking about, you know, the valuation. So imagine if EPS is growing at a CAGR of, let's say, 10%, but the price is not really moving at the same rate, maybe lower than that, then obviously it looks like a very lucrative opportunity in that domain. But then you're waiting why the market isn't correcting. When should you enter in such a scenario? Or maybe should you wait for the market to see a trigger happening at a point in time to enter that particular opportunity? Or even in the contra perspective, let's say if the market prices are growing at a faster rate as compared to, let's say, the EPS CAGR, then eventually, you know, you are going to see that it is, you know, moving in that overbubble territory. So in that scenario, again, do you wait for that correction to happen to exit, or you exit before, well before? How do you go about taking a look at that? Because you said you should take a look at EPS, right?
Got it. So there are two things which you have to understand. It's a little lengthy answer, so bear with me on this. First is whenever the EPS is running faster, when you said 10%, 10% is not a lucrative number. When the EPS is moving at around 18, 19%, Y on Y for a couple of years, automatically the stock starts getting re-rated. So the PE multiple actually starts jumping northward. So the stock starts moving faster than the EPS growth. Okay, so that's number one. Number two, if your EPS is consistent and stock is still not moving, the reason is you should look at is the quality of EPS. What do you mean by quality of EPS? It means it will have some of the challenges which we spoke earlier in our conversation, which means it can be a tainted promoter, it can be, right, it can be problems
cash conversion issues and
absolutely. So if none of it is not there, and just because market is not rewarded, then it's a great opportunity to enter in. However, there are times when there is sheer amount of exuberance. So Shailesh, so as I mentioned, you know, quite a few forums, investing is not complete science, it's an art as well. And hence, you cannot always just pinpoint that this is the right calculated market price at which you should buy.
Right.
You have to see in context of a lot of other things. Let me give you a simple example. Imagine if you are in a industry where your growth, where everybody's growth is 15%, you have been growing at 19%, and hence your PE multiples have expanded. Your EPS, market expectation of your EPS is 22%. You delivered 19%, which is brilliant, right? 19% against an expectation of 22%. But market on that day will give you correction of 9% to 10% stock price. Because market was believing 22%, and you delivered 19% as against the market expectation, which is not wrong or which is not low from any standard. Despite that, you will get punished. And if that is the punishment, that's the day when you should buy. You understand? Because remember, you can't read the market expectation every time. Promoters are working for the company or for the market expectations. Most people think that this company didn't meet the market expectation. Hey, look, the promoter is trying, if his interest is aligned, then he would do everything to protect his interest and the minority shareholders' interest, because everybody's aligned. But if the market discounts way in advance, what can we do? And then there are Bloomberg, CNBC's, all analysts putting pressure, saying that this is the number which should happen. And if this number didn't come, and a number 2%, which is lesser than the number expected, came, and then the stock crashed, that's the time to buy, very clearly.
Got it. So thank you so much for that answer. It makes sense. It makes sense. So moving to the next question, I'm just going to answer that, and in case if I'm wrong, please do correct me, because I think you've covered it earlier. So the question was about young businesses who have no literal history, probably a good revenue growth rate, but in terms of profitability, nowhere close to the horizon. We are talking about the startup India being listed in the markets. Obviously, from an Ambit standpoint, you guys are not at all entertaining such firms, correct? And from a personal capacity, from an educational perspective, how do you go about analyzing such companies then?
Very, very simple. For the startup business, we have no profitability or limited profitability. Look at three simple things. First is how scalable is the business model in itself. See, remember, at this point in time, I'm not talking about the existence of the business. When a startup comes into the picture, it does not always look at that fundamental rule which I said about runway. Because what will happen, as the startup will keep progressing, it will keep pivoting. So Amazon didn't come with a to Z of all products. It came with a bookstore, online bookstore, giving you all kinds of books. And similarly, Flipkart came with a similar thought process. Today, they are very, very different avatar. The owners have changed. Amazon is owned by public, and apart from Jeff Bezos, Flipkart is owned by Walmart. So, but your whole intent is not to burn your money, right? That's the whole intent, that you should not fail. And what you should do is, the first step is, what is the problem? How many people can benefit of the solution which you're providing? That's number one. And solution means, when I say solution, people who can pay for the solution. So business model should be such where people are willing to pay for your solution. And what is that population? If it is only 30 lakhs, 50 lakhs, 70 lakhs, then it's not going to scale up. Because it's a startup. You may initially get 50,000 customers and you'll feel like, oh, wow, I'm there. But your money will get stuck there, because you are an investor. You are not a startup guy. You are an investor, and you will see that this guy is not going to flourish further. So that's number one. So what is the problem statement? And this problem, when it is solved, how many people are willing to pay for it? It may not be available to them at the moment, but once made available, how many will will be willing to buy and pay. I'm repeating this. I've repeated this word pay at least 4 times, only to make sure people, because what you are willing to live with the problem and then pay for the problem. You understand the difference? I'm all right if I have some inconvenience, but am I willing to pay for this problem to be solved for? So that's number one. Number two, very, very simply, is people who are trying to execute, look at their motivation, their passion. Motivation, what is their motivation? How much they, so when I say how do you check their motivation, is very, very simple. Are they doing it just to get any, because remember, even if you fail as a startup, the entrepreneur actually gets a fancy job in any corporate because you have a failure tick with you, right? Because you have learned how to fail better. And then a lot of new startups which have got funded, they will hire you. So figure out the motivation of this guy. Is he really committed? Is he putting his blood and soul into the startup? So you have to meet the people behind it, and it cannot be one, because if it is one, what if there is an eventuality? What if there is a catastrophe? Is there a backup plan? So figure out the second point is more about the co-founders combination, compatibility, and ability to work in harmony with each other. So that's the second thing which you should look for. Number three, again, very, very important. Does the growth gonna can be interfered by the government or any government? Does it have any regulatory challenges? Because as soon as the regulatory challenges will come into play, the margins will remain at a particular level. So these are the 3 litmus tests, or as I mentioned, basic fundamentals which you should check before you even consider. And then there are a whole bunch of things where the money, when they are taking your money at the initial seed stage or at a growth stage at series B, C, or D, where they're going to be utilizing it. Is it a hockey stick growth which is going to happen, or they are only doing loss funding? Do they have visibility of the profitability sometime at sight? Because if not, they are going to be acquired eventually. And acquisition, when you are acquired, you don't have a choice to get money or the valuation which you want. So these are some of the tricky things which happen as you meet more promoters. But first 3 things are absolutely sacrosanct, which are like a filter, you can say. These are the basic filters which will help you remove all the chaff. Then you should start looking at the wheat.
Thank you so much, sir. So the next question, you talked about, you took example of paints, right? We don't really go about painting because we don't really have that kind of per capita income as compared to the Western countries. But naturally, the trend is going to continue, and eventually we are going to be at par with them. So hopefully in near future, or maybe it may take a couple of decades. The question is precisely on that pattern, because the consumer demography and consumption patterns are very different in India as compared to the Western countries. Now, the new necessities which are creeping up over a period of time, and they see themselves having a really big market in India, but because of the low per capita income, we obviously have those challenges. We don't really know whether the new necessities will actually become necessities or part of a lifestyle for Indian population, and how do you go about this? So the question is, how do you go about judging whether the consumer demand is picking up in those particular areas, or probably the growth is picking up in those particular areas, and how long it will take to fructify?
So, Shailesh, one thing I'm very, very convinced about, and all my team members are also convinced about, that per capita income in last decade and a half, it has grown by 3x to 4x. Okay, per capita income is increasing. GDP is expected. So currently we are at $3.38 trillion. We will be $10 trillion by 33-34. So clearly clearly, if you are going to become a 3.5 times the economy which you are today, or 3 times the economy which you are today in a decade or decade and a half, there would be trickling down effect which will happen. Rich will become richer, obviously, their wealth is going to grow obnoxiously. And that is one of the reasons why you should invest into the businesses which we spoke about. And that's the reason equity investing is the simplest way of participating in the riches which the economy is going to generate in next 10 years or 12 years or 15 years. For the poorest man, that is the reason why the equity penetration, which was a decade and a half back, less than 2%, is over 12% today. So very, very clearly, when you say the needs are increasing, if the needs are increasing, people's awareness, people's ability to participate in this economic growth is also multiplying. Very, very simple. 2012, we had a total base of 19.9 million demat accounts. In August 22, we crossed 100 million mark in demat. 5x, over 5x in 10 years. So when people's aspiration increases, they work hard, they save, they invest wisely. When they grow their money, they spend more. So the question can be, so if I have to put the question can be whether in 2 years or 3 years, or whether in 5 years or 6 years, but it has to happen. Now, for example, shampoos. Till three decades back, so India had a total number of villages which were closer to 4 lakhs back then. Now the total number of villages are 2,57,000 odd villages. Back then, nobody understood what is shampoo, what is shampoo. But a small company by the name Kevin Care came out with a chick shampoo of 1 rupee, and that revolutionized the entire shampoo consumption. And today, Heads and Shoulders, which is a premium shampoo brand of $5, is also sold in 2,25,000 villages. So the point I'm trying to make is India is a secular growth story. The question on demographics, the question on income, the question of ability of Indians to increase spending, urbanization, modernization, everything is on the rise. Everything. Today, the urbanization is at 32%. It is going to hit by 20, 30, 40%. You are having under Pradhan Mantri Awas Yojana 2.2 crore houses which have been given. There is another 3 crore which are going to happen in next couple of years. If that has to happen, the furniture, the furnishings, the tiles, the hosiery, the bathroom fittings, even at the lowest strata of the society, they would need it. So think about it. Canada, 3x the land size, 3.5 crore population. India, 141 crore population, 65% of the population between 15 years to 59 years. Earning. There cannot be a question of if. The question is only when.
Got it, sir. I think that definitely answers. But on the same line, actually, the next question. So when we talk of the lower or middle strata of the society, and they happen to be right the face of the consumption right now in India, in that domain, like obviously businesses facing these clients, they happen to be an evergreen investment at this juncture. As you mentioned, there is definitely an inevitability. It's just that we don't know when that's going to happen. But then should we be worried about cyclicality in this domain? Like, is it ever going to peak out, or,
India is never going to peak out. So India has a blessing. India at least is not peaking. So since you asked me a fundamental question, let me give you some stats there. And this has nothing to do with the investing. This has to do with the economics. So demographic dividend, we call it demographic dividend. Demographic dividend. So Japan was absolutely down in the dumps after 1944. There was abject poverty. In 60s, their demographic dividend started. And you know what happened to Japan, right? So they became the market leaders in technology, stock markets rose, per capita income rose like crazy. 2001, their demographic dividend ended. China, 94, their demographic dividend. And what is demographic dividend? It's very, very simple. Demographic dividend essentially means people who are dependent and people who are earning, or the younger people should at least be 2 times to 2.5 times of the people who are being dependent. Very, very simple. That thing started for China in 1994, and it's going to end in 2031. You're already seeing 94, China was not even amongst the top 10 economies in the world. They had a famine behind them where 22 lakh people died of the famine. And today, China is the second largest economy with a manufacturing hub, poised to become the largest economy in a decade or so. India, 10 years back or 20 years back, was in the bottom 10. Today, we are already the 5th largest economy. We are soon going to supersede Germany and then Japan. Our demographic dividend actually started from 2018 and is going to last till 2050, in a secular manner. 2057, it's when our aged population is going to start increasing. So 2057, we are talking about, we are in 2022. So all of you guys who are young people, you are at the brightest time of India, brightest. See, I have less runway as you. Even if I die in 96 or 100, I still have less runway than you. You guys are half my age. Hence, you will see the brightest India in your peak time.
With that optimism, moving to the next one, obviously. Sir, you talked about a lot of checkpoints from a forensic perspective, from sectoral perspective. In terms of small caps, often people face this issue of information barrier. How does Ambit go about looking at things at that point? Like, how do you go about investing in small caps? Because it's literally impossible for people to crack into, let's say, rarely companies do con calls, or investor presentations are not that readily available. Even forget about any other aspects of cracking the information in those domains. How do you go about looking at such companies?
So very, very simple. First, Shailesh, we look at those aspects which I said about the forensic 11 parameters.
Right.
Debt to equity, promoter skin in the game. Right. That gives us a very, very finite number of 40-50 companies, and then the ROCs, revenue growth, EPS growth. So that gives us the capital utilization, focused capital approach, which you mentioned in your conversation. That leaves us with barely 40-50 companies which we like. Does not mean we invest in all of them. Then what we do, we make a conscious effort to start understanding their ecosystem. So who are their distributors? So it's a lot of legwork to build relations with the ecosystem, and an ecosystem to talk to us. Right. For the promoters access, thankfully we have an investment banking team. We have other businesses which exist in Ambit. And because of that, we are able to meet the ecosystem and the management and the board of those people. It makes our life a little more simpler. That's what. Questions are independent. Our research is independent. The only thing is, since it's Ambit and Ambit's credibility, we are able to go to them, and they believe that what we say, it's gonna be in private, and we take permission, whatever we can share, etc., etc., etc. So because of the group synergy, it helps us good corporate access, if I may use the word. So that's one on the small cap side. Second thing is, most of the filters help us to remove any dodgy businesses which can come into the portfolio. So our risk of dying, our risk of businesses meeting with an accident reduces tremendously. Tremendously. Then the only question is about the growth and the future. We are very, very blessed that in our 7.5, 8 years we'll complete in March, and from the asset management perspective, we have never gone wrong on understanding the business, or on our call, never on the business has gone wrong. Stock price multiple times, not on the business. So we believe that we are like army personnel. Why? Because terrorists have to only create one incident, one mishap. We have to make sure that 100% of the time we have to first protect. Because one wrong call on the business, and if the stock price corrects by 80-90%, you have lost the earnings or the returns of 5 years or 4 years. So very, very cautious, very cautious on that.
Got it. And sir, from from a individual perspective, because we teach this a lot to our candidates, and we also ask them, and this, by the way, is in conjunction with another question down the line, like we ask them to meet ground level, conduct channel checks, meet distributors.
Right.
So our students go about meeting distributors, but at times we face that even these students, they face difficulties in cracking to get information from these distributors. Any particular approach you think probably could help our students gather information on channel checks at their level without actually tapping into a mass network as an organization of yours has?
So very simple, Shailesh. Remember, unfortunately, this is Kalyug, this is not Satyug, and hence every person looks for something in return.
Right.
And what can you give? What can we give? And that's the same thing. What can you give? So first thing is, when your students approach for the channel checks, and that's the right way of doing it, is first thing what you should do is you should be thorough with the competition from the secondary data which you have. So imagine you are focusing on company A's distributor. You would know that 20 other companies are doing whatever they are doing. How is the industry growing? How is the other distributors doing? So study that well. Figure out as if you are into a consulting business, not in research business. When you understand that, how can you grow his business, which is, imagine if we are coming back to the paints, if he's a retailer of a paint, or if he's in the biscuit distribution and he's the wholesale, then if you understand how and he has the distributorship of Parle G, you figure out how Britannia is doing, how ITC distributors are doing, how the industry is growing, how to increase his margins, his profitability, how other people are doing. You may not have primary data, but you surely can do secondary data checks. Make a mindset of advising him how he can use his capital efficiently, grow his business, negotiate with the company he or she is dealing with in a better manner. First, you give that. And the opening thing should be, we are here to grow your business. And then we want to understand, how are you facing problems or you are finding success in your business. But first, we are here to grow your business. And then you start from the capital first. So then you say that, I assume that your capital is stuck because of so and so. He will immediately open up. And then you give him solution that, hey, look, why don't you start looking at this bank for this OD facility for a short time, or etc., or take a smart home, or do something. Don't get into a pure term loan. Do this, that. Give solutions. Give solutions. One solution, 50 number in quantum, 50 times the information you can get. One solution. That's about it.
It's a brilliant approach. It's definitely a brilliant approach. Obviously, I think this answer is definitely going to help our current batch of students who will be graduating. So thank you so much for that answer, sir. In terms of, I think the questions we have covered, and I believe we are just at the time breach. So I'll keep last three very simple questions, where we actually want to learn from you is, and these, by the way, are from me as well as Prateek, who is basically a co-founder of Finacle. First is, maybe if you can help us with any impactful yet unheard of reading recommendation which can help us around develop a sound process, as well as for our students to develop a sound process on how to go about thinking or building a particular business.
Okay, so the first, so you are asking me for a book, right?
Right, sir. Any blog, book, whatever, any particular author as well whom we can track, unheard of and yet extremely impactful.
So I believe that the best way of doing this is, whilst your students are doing, they should start experimenting by investing themselves, even if that means that they should invest as small amount as 5,000 rupees. They should start, because what will this exercise do is, when your money is at stake, then the pinch you get, when you lose it, then it propels you to find answers automatically.
Right.
So, so that's number one. Number two is, Peter Thiel is one of the known guys, the gentleman of PayPal. So he has written several books, and a couple of books he has written on the business and understanding the business. You should read, because, and not from, so remember, don't read about financial accounting, how to build business, etc. Read about the core of the business, core, how businesses are built. If you understand how businesses are built, you would know how people destroy their own businesses by fleecing them. So read any book which talks about building businesses, whether it is Nike, you know the book name, you know the McDonald's, in India there are a whole bunch of guys who have built businesses. Read how to build businesses. That's it. We are born entrepreneurs. When we came out on this planet, we started crying for milk. Nobody taught us that we have to cry for milk, because our mothers will only give us milk when we cry, because if we don't cry, if we are smiling, mothers will say the child is happy, let him be, or he is in his own sweet land, do not disturb. But when you start crying, then the mother is worried, and then the mother will figure out whether he has done susu, potty, or he or she is hungry. So we are born entrepreneurs. The problem is, because of the education system, we have become corporate slaves. So you have to get out of the corporate slavery thought process, get into the entrepreneurial mindset, and that will only happen if you read how businesses were built and how people failed in their businesses. That is the second step. So what then, it will tell you what not to do. That's it. Don't read about any forensic investing, anything. Read about business. When Shailesh, you built Finacle, you didn't think about forensic accounting. You thought about revenues. You thought about expenses, moti si baat. Rest, everything is on top. So that's the bottom line which you have to understand. Simple.
Thank you, sir, for that answer. So then the next one is basically, what mistakes did you make in initial years of your career? And you'd want the young generation to avoid it, or probably commit the same mistakes to be where you are right now.
Sure. So I think in last 15 years or 20. So initially I was fine. So God was very kind that in my initial career, I got quick success, good success. For initial 3, 4, 5 years, I got very, very fast, rapid success. And somewhere in last 15 years, especially, so out of my 21 years of my work, last 15 years, I became a little complacent. I started taking lesser risks in life. So my request to all of you would be, since you are half my age, and that I tell everyone, as you'll start growing older and older, your ability to take risk, and as you become much more educated, your ability to take more risk, as you listen to more number of people, your ability to take risk reduces multifold. So first, there is no need to get so much educated. If you want to be in that 0.1% or 1% of the world population, which is ultra rich, stop studying too much. Study when you need to study, which means you need to find answers. Then study. Second, take more risks. Even if you have everything to lose, ensure that you have just don't have a scenario where you have to beg or steal. That's about it. Have that much money where you don't need to beg or steal. If that money is there, take as much amount of risk as possible. Don't worry about it. So that's number 2. Number 3, just build business. Just build business. And even if you fail 3 times, remember the 4th time, you'll be invincible. And law of averages has to catch up in everything. But if you only do one business, it's a 50-50% chance. You can lose, you can win. So very clearly, the simple one word is take risks in your life, not in investing, but in life.
Thank you so much, sir. I believe those words have definitely left a huge impact on all of us. Thank you so much for taking out time on your calendar and going overboard than the time you had given. So we really apologize for that. And we've definitely learned a lot through the course of today's session. We hope that you'd give us similar opportunity in future to learn again from you, and it really means a lot to us. Thank you so much, sir.
Thank you, and God bless you all, and especially for one final word. That's a special word for the girls and the women participant of this program. Remember, if you're employed after studying so much, not for anything, quit your employment, not for anything, not for family, not for your child, not for your mother, not for your in-laws, not for anything, not for anything. And if you're starting a business, don't quit your business irrespective of anything, because remember, you will only be treated for the value you bring on the table. And if you take a back seat thinking I am the giver, there are multiple ways of giving. Remember, instead of you doing the household job, there are people who can assist you. They need your salary. So you earn 10x the salary, give them 1x the salary, employ those people rather than you doing the job. Don't lose your intelligence, hard work, and perseverance you have put to come here. And after that, after a couple of years of work, leaving everything, not worth it. Even if you get married in the in the best of the household, still work. The kind of person you will be, it'll be phenomenal. So that's a kind request to all women and lady participants of this program.
Thank you so much, sir, for the piece of advice. I'll stop the recording.